Yeah, I think top of the mind really is, the tariff situation and how it's going to impact the Chinese market. And as we can see, last week was an epic week for the Chinese stocks, right? So Hong Kong stocks suffered a really bad sell-off on Monday, but then we staged a really strong comeback. I think traders are expecting Beijing is going to come up with new stimulus measure, to sort of offset the impact from tariff. But I think so far, there's very scant details being announced, and also the social financing data is actually stronger than expected because the Chinese government is selling more bonds than expected. Right? So obviously, physical machine is starting to work. So I think hopefully, with a little bit of steam being let off from the U.S. side, this week we can have a even further rebound from last week's low.
Is the floor in, you think, in markets, Chinese markets specifically?
I would say the 19,000 level for the Hang Seng last week is a really good and a really good entry point with a reasonable valuation as well.
I think traders are also trying to understand the relative strengths of the US and China as we enter in possibly or are in an economic war. And you mentioned treasuries and the tools that China has at its arsenal.
Yeah.
Do you think that they're also intentionally selling their holdings to destabilize?
Yeah, one shouldn't be too surprised to see, right? So, because in this negotiation, China has less negotiation chips than the U.S., right? So, you have to resort to things other than tariff, other than imports and exports to put pressure on your opponent. So I think last week, when the tariff was first announced, the U.S. Treasury actually rallied substantially. I think 30-40 basis point in one day. But then suddenly, there was some sort of a forced selling in the marketplace, and therefore, it probably blow up some basis trade. But I would say that the trigger is actually set off by some Chinese selling as well. Even though they're saying that, most of the Chinese holding of U.S. Treasury, is with the U.S. banks, right? So it's the U.S. banks acting as a custodian for the Chinese holdings. But then at the same time, we all know that there are like lots of Belgian accounts the Chinese government use to accumulate the U.S. Treasury bonds. So you can sell some of those holdings as well. So I think last week has been a very sort of a volatile, epic week for all assets, not just for the Chinese stocks. I think for the U.S. stocks, it went through a tremendous volatility period as well.
Yeah, it was a bit crazy with the VIX above 40, which is really a level that you don't normally see apart from periods of stress. But speaking of the lack of, or the glass is half full on ambiguity, the U.S. president is in fact speaking right now on Air Force One, talking about how the financial system, it's very respected, that there should not be any ambiguity in financial markets. I guess, tell me this then, we've seen several downgrades to Chinese growth, economic growth. I think Goldman Sachs also came out and slashed their forecast. Will there be a hit to earnings in China from this?
Well, I think, one shouldn't be too surprised, right, to see a huge hit on Chinese earnings. I think, if we assume that all the exports to the U.S. go away, right, so then obviously there will be ripple effect on, the factories that is operating here, manufacturing just for the U.S. destination. So one should be too surprised to see 1.5% to 2% hit on the Chinese GDP. Right, so this year we're trying to do 5% growth, and then we have to reduce it to like 3-ish% for 2025. So if so, then many of the export-oriented companies will get hit as well. So I think right now, even though the market is starting to price in this kind of ultimate scenario, but in terms of earning expectation, we're still not seeing analysts downgrading their earnings estimates that much.
Actually, on that point, there's some interesting news out about plans from JD.com, Meituan, Alibaba's Fresh Hippo to try and sell more of their export-oriented products to a Chinese economy.
I think the Chinese government has been trying to stimulate the domestic market for a long time now. I think ever since 2007, right? So the Chinese economy was talking about restructuring towards a consumption-based economy because in so doing, then the economy would be less volatile, right? So it will be less investment-driven. and therefore, the volatility in the GDP growth would be substantially less than before. But then over the past 10, 15 years, for some reason, we're even more export-driven than before. We're even more investment-driven than before. So I think as a result, now we're entering this sort of a tricky period where you have to cope with the pressure from the U.S. And then at the same time, your domestic market isn't fully mature just yet, right? So the Chinese consumption as a percentage of GDP is less than 50%. It's one of the lowest in the world, especially considering now the Chinese per capita GDP is about $14,000, right? So it's quite substantial. It can be classified as almost like a middle income country, but then at the same time, for some reason, consumption is still not boosting up.
What would you recommend investors to buy?
To buy
in this market?
Well, I think last week, we were seeing gold, for example, and the gold miners stage a really strong performance, and also the SOEs, right? So the SOEs are going to get subsidies and supports from the government, and also going forward, after this huge volatility subside, one should be expecting the tech sector should have strong support from the government as well, because that is being regarded as a forefront for U.S. and Chinese competition going forward. So, and that's the reason why, after a huge sell-off last Monday, and then, the Hang Seng Tech Index is staging a substantial rebound.
Yeah. All right. Hao Hong, you're staying with us. We're going to have more with Hao Hong, the incoming CEO of Huafu International, in just a couple of minutes. But we have just got another update, actually, on these tariffs on semiconductors in particular. President Trump is also saying that he's going to announce the new duties over the next week. This does follow this exemption that we had going into the weekend on consumer electronics broadly. But President Trump pledged to apply tariffs to phones, computers, popular consumer electronics despite that, and he said he'd be taking a look at semiconductors and the whole electronics supply chain in particular. So we'll have more details on that ahead. But you are watching the China show and you are seeing some of these names, BYD, Sunny Optical, AAC, I mean, these are sort of Apple suppliers as well, moving in the green so far this morning. This is Bloomberg.
Monday came early. Oh, my God. All right. So it doesn't feel like we had a weekend. It doesn't feel like we had a commercial break, really. Breaking news, couple of things. The dollar continues to be on offer. Left side Bloomberg Dollar Index. No, in fact, that's both the Bloomberg Dollar Index. So you have an intraday look. You have a sort of multi-year look. The Dixie is actually below 100. We've now actually hit the lowest, the fresh low for the year on the Bloomberg Dollar Index. That's point number one, right? Point number two is Howard Lutnick, before the headlines broke a few minutes back, talked about how, this exemption Donald Trump talked about on electronics as a reclassification under a different basket. So Howard Lutnick actually said that, we will get probably in a month or two details on semiconductor tariffs. Now, we have more clarity on that now. In the next week or so, the red headline that also crossed terminal earlier on, was it a red? Doesn't matter if it's a red headline. It's an important headline. Donald Trump saying that they will announce tariff rates on semiconductors over the next week or so. So that deadline or that timeline is being brought forward. What's interesting is amidst the aversion, the dollar's not catching a bid, but I guess that's a different set of kind of worms we can get into.
It's the big question around the confidence in the greenback as the cornerstone of the global financial system, and you're continuing to see gold that's being bid, for instance, especially after the PBOC added to their gold reserves as well. But Bloomberg Economics is thinking that a full US decoupling of US-China decoupling rather now looks much closer. That's given the latest tit for tat tariff war. Let's bring in our chief Asia economist Chang Shu joining us. So talk us through the view. Why have you brought it forward? I mean, I guess there's a lot of headlines that might suggest why, but talk us through the details.
Yes, we're at this point trying to wrap our heads around all the details. The latest exemption is temporary and can only offer a very marginal sort of relief for the Chinese economy. If we look at the effective rates, it's still, based on our calculation, is still above 100%, in fact above 110%. So that relief is not huge, and the tariff is highly discriminatory, right? It's China's tariff is much higher than the rest of the world. Therefore, we're losing competitiveness quite significantly. So we do see, the impact GDP exposed to exports to the U.S. could be dropping slightly from 2.5% to 2% of GDP or so, but that's still a huge hit for the Chinese economy. And maybe just a week or two so ago, we would have thought the decoupling between China and US is pretty far-fetched. Perhaps today, when we look at it, this idea is less far-fetched than only a little while ago.
Hao Hong is still with us here on set, incoming CEO at Huafu Securities. A question for both of you, really. Financial News, which is a PBOC-backed paper, put out an article on Sunday. When it comes out there, typically that's a leading indicator of what the PBOC is going to do. PBOC may cut interest rates and reserve ratio requirements. They've said that, though, for a few months, and we're still waiting for that action. Right. When do we get that window of aggressive easing coming through?
Well, I think as the tariff picture becomes more clear, then I think, the government should think of some immediate response. I'm pretty sure that they have everything ready, right? So, for example, the way they respond to the tariff initially, right, by putting it a counter tariff on the U.S. goods, it shows that it's a very comprehensive list. It shows that, the Chinese government has been preparing for such scenario. I think going forward, since late last year, PBOC has been talking about cutting RRR, cutting interest rate, and also loosening the monetary policy. But I think, right now the focus really to keep the Chinese yuan steady, right? Because once you get hit by the tariff, and then if capital starts to fly out of the country, right, so it will become very, very messy, very volatile as well. So I think if you cut interest rate and RRR now, it could put downward pressure on the Chinese yuan. So I think that is probably one of the reasons why, they are not cutting it right now.
Very much agree with how I think for the PBOC, easing in April is quite important, sending out a very strong signal. We do see at this point potentially a cut in the policy rate and a cut in the RRR, both in April. But what we feel is important is the fiscal side. Fiscal side will have to do the heavy lifting. We expect the government to speed up the stimulus delivery and potentially signaling additional budget to come later in the year. But the moment is really now, because now the public opinion is largely behind the government to strongly push back to the U.S. very strong stance on China. Our pushback is important. Is strong, and the public supports that, and it's important to sustain this sort of confidence in this stance. So that should be backed up by public government support for the economy.
Yes.
You're nodding and share your views, Hao Hong.
Yeah, well, I think, right now what is working for China really is, the US dollar is weakening, right? So it's sort of reversed its traditional safe haven sort of status, right? So it's trading like emerging market currency, right? Because people obviously are losing confidence in the US dollar. So I think, people are probably, swapping their US Treasury holdings for gold, for example, and one shouldn't be too surprised to see, the Chinese yuan probably, despite all the pressures, holding steady, because once you're not holding the US dollars, you have to hold something else, right? So, and also in terms of cross-border trade settlement, close to 50% now is being settled in Chinese currency, right? So, but mostly it's settled with the Middle East countries and also settled with the Russians. But even so, it's close to 50% settlement using the Chinese currency. So I think the Chinese yuan is probably its position is stronger than before, right? So back then we didn't have much string to pull, but right now we're probably in a much stronger position. And so, as the US dollar weaken, as the US Fed ready to cut its interest rate, the interest cutting window for the Chinese central bank is opening. Right? So, and also, depending on how much impact from the U.S. tariff on the Chinese markets, for example, if we continue to get gigantic volatility like last week, then one shouldn't be too surprised to see an imminent interest rate cut from the PBOC.
Which I guess also helps, to the point you're making, also helps if borrowing costs are falling for the government, right? And I think one of the things that you mentioned how earlier on, the March credit numbers, does indicate a massive buildup and selling of bonds. Do we expect that to continue moving forward?
I would imagine so. So, in a way, we've been talking about monetary loosening. So that seems to be coming on stream, and we do see this going forward. And the government could be, as how indicated, could have made all sorts of plans, and we do expect stimulus delivery to come up as soon as possible. But we think the visibility of such plans would be quite helpful for the general public to maintain this sort of confidence and sentiment.
Hal, just ask your final thoughts here. I mean, we're very early days into the Trump administration. What's your outlook for the next, say, couple of weeks, month, quarter? Yeah,
well, I think one should be ready for the worst-case scenario, right? It seems to me that the U.S. Trump is really determined to decouple from China, right, and also relocate all the production facilities back to the U.S. and also back to the U.S. allies. So in so doing, the hit on the Chinese manufacturing sector and the export sector can be quite substantial. So I think people should be ready, for the ultimate scenario that is not thinkable even a few months ago.